Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Wednesday edition of Benzinga's Pre-Market Prep. Spencer Israel here with Joel Elconin and Dennis Dick. Well, it's going to be an earnings show today between Netflix, Snapchat, Delta Airlines, Chipotle, AT&T, Kimberly-Clark, Interactive Brokers, NASDAQ, Biogen, a lot. That's just a few. A lot on the earnings front today. So that'll be the theme of the show. We'll talk about BNTX as well. They're getting a huge pop thanks to positive development for their COVID vaccine that they're doing with Pfizer. Our guest today is David Trainer. He's the founder and CEO of New Constructs. He will join us at 8:35 to tell us what to look for deep inside of these earnings reports this quarter and which reports he is most looking forward to for beats or misses. Joel, what's the word here in the overnight session?
We're green. We're green by 32 handles. If you were up last night and you were so inclined to buy yesterday's low at 27.17 and a quarter, that was a little bit after midnight, I believe. It was before midnight, around 11 o'clock, 10, 11 o'clock. You got a good buy off because we rallied 60 handles off that. 27.77 is your pre-market high. That's not a bad level either because your intraday high from yesterday was 77.50. So good levels on the top and the bottom, but we're just in the middle of nowhere here. Gold up $26.70 at 17.1450. Silver dancing above and below 15, up 11.9 cents at 14.99. And you have Bitcoin still around 7,000, up $95 at 6,985, and only $170 range. So quiet range here. We haven't really been talking much Bitcoin, but Triple D, did you get down and dirty in Netflix?
I tried to trade it a couple times. You know what? It was so choppy. I got chopped up twice in it. So I was like, no, I'm done. So I was just trading and, you're looking and when you watch something for so long, you can't help but trade it. So I was jumping in, not big size, just kind of jumping in and getting a feeler. And I thought, okay, here we go. And then you're on the wrong direction. Then you're trying to minimize the damage. And then I tried it again, wrong direction, try to minimize the damage. Like, no, I even said to my buddy at Bright, I was like, I got to stop trading Netflix. I just took it off my screen because sometimes you're in the zone and sometimes I can trade that kind of stuff. And then other times, that kind of stuff is tricky to trade, and it was a lot of chop, Joel. I mean, we went all the way up right on the initial number. I believe, what did we get to, 480?
485.95.
And then we started leaking, and then we chopped around a bit, and then we really started leaking, and then we were red, and then we started to come back up to green. So it was a chop fest, and you know what? I got chopped up in it too. I think I ended up losing about 2.5 points overall, so not too bad, but definitely wasn't trading it well.
Spence, you want to go with the report?
I'm probably the only person.
Sure.
I'm probably the only person that lost money in it too, trading it.
Everyone on Twitter made money.
Everyone on Twitter made money for sure. You know that. They all make money on everything. Twitter never loses.
The Netflix numbers, the EPS, it is what it is, $1.57 versus $1.65 estimate. So a miss, but I'm not putting a lot of weight in that. Sales $5.77 versus $5.76 billion. So, the numbers are what they are. The big headline was their new subscribers added. They added 15.77 million subscribers around the globe. That is twice what the street was expecting, and it was split up pretty evenly across the board of 2.3 million new subs in the U.S., 3.6 in Latin America, 3.6 in Asia Pacific. So it was pretty evenly split. Their new subscribers were around all the major markets, and they did guide. They gave a couple forward-looking statements. They see their Q2 global streaming subscribers at 190 million. That would be up 25% on a year-over-year basis. And they did also guide their Q2 EPS at $1.81. versus a $1.54 estimate. So some guidance from Netflix, but it was if you listen to the call or watch the coverage, it was a pretty uncertain report.
Yeah, like when they were talking too, you think these were awesome numbers. So you automatically think that, well, they're going to be saying a lot of good things on the call. And then really it was, they were talking about, the subscribers and saying they don't know what's going to happen once we reopen. If, a lot of these subscribers are it's just a temporary increase. So, with all that being said, I was actually surprised the stock really didn't start tanking when they initially started talking like that. It held up for a bit and then eventually started to come back down. So they were, there was a great report. There's no doubt about it, but they were very concerned that this might not last. It's kind of how I was reading it, or at least, reading the highlights as they were getting published there in the Pro.
And that's exactly what Gene Munster said. He said the one word to describe this report is temporary. And I would even say the same thing for Snapchat too. Snapchat, great quarter, temporary. We don't know how this will impact. And Netflix even said we think this could lower our growth in the coming months. It just sped the growth rate up a little bit. But great quarter, great subscriber growth. We knew they would blow it away. Thank you very much, Tiger King. But long term, I don't know how sustainable these numbers are.
I mean, it's tough when you have that kind of trading action. I think I can comfortably say that the pre-market high will hold.
Oh yeah,
might hold for a couple years. Coming back on the downside, the pre-market low was 416.82. I'd like to see if it can get unchanged on the session. Yesterday's closing price is 437.49. I'll look at that as resistance. If it somehow manages to get through there, then there's a pair of highs at 445. But I don't know. I mean, it's probably a short. I just don't know where. You know what I mean? Do you want to sell it down $9? You can. I don't know. I think this thing just has so much air underneath it that just looking at the daily chart, I could see this thing, if it came back like to 380, it wouldn't even be a 50% retracement of the rally up. So that's my take on Netflix.
The one concern, and this was yesterday, and I can move into my Shopify trade, but the one concern was all of this money that was hiding out in these COVID plays really came off yesterday morning. At one time we saw, look at the red candle in Amazon. Just got slammed. It opened at the highs, they hit it down, and then it hung out for a little bit, and then they slammed it down another 100 points. Netflix was the same story. They opened it, then they hit it down, and it held up better probably because it was due to report, so it held up better than the other ones. But then there was Shopify. And Shopify, same story. We talked about Shopify on the show yesterday. I said I had sold my Shopify in my long-term account the day before. I sold around 620 equivalent because I just thought it was overdone. It got just silly again, just continued to go higher. I had one of my best trades in a long time on Shopify yesterday. What I saw was Amazon opening at the high, tanking. Roku opening at the high, tanking. Netflix opening at the high, not as tanking as much because, like I said the earnings, but they got hit too. It came down significantly. And then Shopify opened up and ran up a bit. And I'm like, are they going to just buy Shopify when Amazon and this has been on the hiding place and all these stocks have been moving together? So I tried to short, and I went short at 659. What I did was, because we had a couple tops, 663 just on the day trading chart, and I'm like, if we make a new high, I'm going to stop myself out. I put my stop up at 666, and that's always the magical number, the 666. Put my stop at 666, and I walked away from my screen. And it started coming down, and I couldn't help. I kept checking it on my phone. I couldn't help. It went down to 640, and then I called you when it was 640, and I was like, this thing could just collapse from here. And you even said this could get an ugly red candle. So I'm like, well, where do I cover? Where do I cover this short? I short at 659. And you're like 585, which would have been the previous day's low. And I'm like, that sounds pretty good to me. Well, I'm watching. I couldn't help myself. Went down to $600. I was like, okay, I'm covering half. So I covered half just above $600. And then I held the other part of it. And actually, you're not going to believe where I covered the other half, Joel.
Yes. let me see here.
Is it? It's luck.
Don't
Just
tell
BS
me.
luck.
Don't tell me 556.01.
Like 560. So
No
I
way.
literally on the bulk of the about half of the trade, I covered half obviously too soon. I basically shorted the high and bought the low on Shopify.
If I tell you to buy 584, why
I
do you buy
just put my order at
600?
584. Listen to Joel.
Why?
I actually would have probably
That makes no sense to me, Dennis. I tell you to buy 584 and you buy 600. What the hell are you doing?
I bought half. I held half just for you. I would have covered the whole thing, but I knew you'd yell at me.
Okay. But you know what I will say? Your average came out right around 584.
Right around 585. Yeah. I averaged, actually, I think at the end of it, it was 67 points or something I averaged on it.
That's crazy.
So, and you're talking at 600. So I made 10% on that swing trade, and I was in the trade for about an hour. So
I'm again, like, walk away. And then I get a text. 620, 630, 6.
I know it just kept going down. I was like, I want to cover so bad.
Yeah. I don't know if you...
Okay, so why did I put this trade on? So everybody can learn from it. Because I recognize that there is a relationship, at least for now, between Roku, Amazon, Netflix, Shopify. And I see 3 of the 4 tanking. I think Shopify follows suit. It wasn't on the chart. I'm not looking for any of those reasons. I'm simply looking that 3 of those major 4 stocks have all kind of been just flying up together because we're never leaving our home ever again, started to show a lot of weakness. And Shopify lagged. And it lagged for about 20 minutes. And then eventually it caught up too. So identifying those relationships, and we know I am a relationship trader. That is what I am. I'm not a technical trader. I use charts, but maybe to find where my out is, like Joel was saying, or I call my technical analyst, where do I cover? But I enter trades based on relationships. And I recognize that there is a relationship between Amazon and Shopify. It's been inversely correlated for a while with the overall market. Yesterday, that correlation broke down significantly, obviously, because the markets, we saw a lot of those hiding spots for the COVID plays tanking as the market was tanking as well. So that tells me I believe Amazon put the top in now, at least the short-term top. I believe Shopify probably is putting a short-term top. So I'd be more of a seller of bounces on these stocks now. Still love Shopify. Talked with Nick. I'm going to put my order down at the 50% retracement to try to get my shares back that I sold at the 620 because I obviously had it long too. For in my longer term account. So 350 up to 650. That's a 300-point move. Let's knock 150 points off there. We'll say $500. Comes back to 500, I may rebuy my Shopify that I sold in my longer term account.
Okay.
But at this time, if you're buying those stocks now, I believe you're on the wrong side of the trade. I believe yesterday was the candle, the reversal candle. So I'm not a technical analyst, but the relationship broke down yesterday. And I often, when you see short-term relationships break down, they stay broken down. And that relationship being market goes down, we got to pile into Amazon, we got to pile into Netflix, we got to pile into Shopify, we got to pile into Roku. That broke down yesterday. So I believe that relationship is now broken. Even this morning, with the market up, Amazon is trading up. Even this morning with the market up, while Roku is still trading down. Some people are spooked on that. But Shopify trading up. I think the Shopify bounce this morning is a sell. Just my opinion.
But what about still, like today? Like, would you, it's up 17.25.
Yeah, would I reinitiate a short? Maybe. I mean, where is my out now, though? Like, it's, I'd have to look at where it opens and, where the trading is, because I don't want to, you got a huge candle here. I mean, to figure out where your out is now is a little bit tricky. I mean, you could go to that high of the move yesterday on the.
No, I can give you. I mean, if you want to sharpen your scalpel here, what was the high yesterday? 665.74. We'll just keep it real. Because I actually, after you covered and it bounced, I was thinking of trying to get it shorted, and I was looking for, I believe it was 610. Let's see what we got here. Yeah, I was looking for 610, and it never got there. That's half of the rebound. So if it gets up to 610, I'll see how it reacts there. I mean, you are getting a nice lead on it here, being up $18. I think, some of it has to do with how the market holds up too. But
yeah. And obviously this had been moving inversely correlated with the market for a while. But like I said, I believe that relationship kind of broke down there yesterday.
How about Snap?
There's money to be made in relationships, and I think there's too few of traders that use them. I mean, Bright Trading is all based on stat arb and relationships, and a lot of our traders are amazingly consistent. And the reason for that is, like I always say, you can use charts, and charts help, but there's 6 million people looking at charts out there. If you really think it's a huge edge, you look at the chart different than the other 6 million people. I mean, if you're making money on charts, keep doing it by all means, but I think it's only one tool in your toolbox. I've never in my 20-year career just been able to look at a chart and say, this is what's going to happen. I'm going to make money from this. I've always made money on relationships. That's how I'm different. So if you're doing well, continue to do well. Continue to use charts. If you made money for your last 10 years trading just using charts, by all means, continue to do it. But if you're just first starting out in trading and you're trying to use this chart and you're reading all these technical analysis books and you can't figure it out, you know what? I read a lot of technical analysis books back in 1999, 2000, and I never figured it out either. So that's why I moved on to relationships and I found something that worked for me. So find something that works for you.
All right, Joel, you want to move on to Snapchat?
Sure.
Is that what you want to do? All right. Snap reported after the close yesterday, adjusted EPS, they lost 8 cents, missed by a penny on the estimate. Sales of $462 versus $431 million. They also reported daily active users up 20% on a year-over-year basis. So it's just like Netflix, a massive temporary, we think, spike in time spent on the app and time spent watching content on the Discover tab and on DAUs, but they're still losing money.
This is a super interesting chart. You bumped up to what your pre-market high is 1520, but you're not leaking. I mean, you're just hanging in there. Is there an iceberg around there or something at 1480, 1485, Dennis?
There's a few people holding it up.
Yeah, they're holding this up maybe to whack it after the open. I don't know. But I think the setup here, holding 1480, I wouldn't be long this stock with my worst enemy's money. Huh. That's what I'm looking at.
You're telling me you're not a fan of this one?
If it doesn't hold 1480, I'm just looking at this. I know I'm based on no relationship, just looking at years and years of pre-market charts. This is telling you that if this thing's going to rip to $17 today, it's going to hold this area and go. But I would not want to. I mean, there's a long way to go in this thing if you don't hold 1480.
I'm not buying any stock trading up 20%, and that's just my style. I don't chase. I don't say, oh, the stock that's going up 20% is going up 30%. Folks, we are not in where we were 2 years ago, where the stock that was up 20% goes up 30%. I was trading like that 2 years ago. I wasn't afraid to buy a stock up 10% because I thought it was going up 20%. That bull market is long gone right now. Now it is the fade trade. It has been the fade trade. We've been talking about this way before COVID. Even the year 2019 was more of a fade trade. There was a lot of moves. Yes, we had the ridiculous rally at the end of the year, but there was a lot of chop in 2019. And if you were fading, you were making money, by looking, when the stocks are ripping up 20%, you're selling them. When they're falling 20%, you're buying them. And that has continued to work even with COVID. We've been talking about this. So when you're coming in, you're buying stocks that are trading up significantly, saying the 20% stock up goes up 30%. Sometimes they do, but a lot of times in this market, they don't. So I'm not chasing Snap here for those reasons. I don't know where it's going. I probably won't trade it because it's a difficult one to trade. I don't often trade the leaders too. And somebody was just asking me about relationships. So on Snap, when Snap takes off, what am I looking? On the headline, Snap's ripping. I'm not looking to buy Snap. I'm going to buy some Twitter. I'm going to buy some Facebook because these stocks have a relationship with Snap. So if you look this morning, Twitter trading up 4%. Why is Twitter up 4%? Because Snap is up 20%. Why is Facebook up 3.5%? Bigger company, not going to move as much, not going to be as volatile as Twitter, but it's up 3.5% because Snap is up 20%. There is no other reason.
Pinterest too, Dennis.
What's that?
Pinterest too, PINS.
And Pinterest, great one, Spencer. PINS, same thing. Those move with Snap. So identifying those relationships can make you money, sometimes on the headline, sometimes not. Sometimes there's a quick reversal. And believe me, there is a lag. There is not every algo that's just programmed to just trade those relationships. There's some, that are very sophisticated and will trade those relationships. Don't kid yourself. You'll be battling algos. But if you're battling the algo and you keep getting beat to the trade, you at least know you're on the right side of the trade. If you're battling the algo and you're getting filled easily on your orders, you're probably on the wrong side of the trade. So just knowing those relationships again can make you money. And sometimes you get them, sometimes you don't, but I love my relationships.
That pre-market high at 1520 coincides with the 1528 high from February 27th, and then it really opens up on that. But I think the pre-market chart here is giving you a pretty good look of how the session should go.
Let's keep going on the earnings parade here. It's kind of fun to not talk.
I know. I said that to Spencer.
And not talk about oil for one day.
Well,
although we're probably going to talk about oil.
Well, we'll talk about that eventually. All right,
it's coming. It's coming.
USO.
Let's look at Delta Airlines here, DAL. So, yeah, we knew it'd be bad. It was bad. They actually beat the estimate on the EPS. They lost 51 cents a share last quarter. They were supposed to or projected to lose 70 cents. Their sales came in lower at 8.59 versus $8.92 billion. This is just mind-blowing to me. If you look at an earnings calendar of Delta going back a few years. So a year ago, in the Q1 2019 quarter, so a year ago, they made 96 cents per share. Last quarter, they lost 51 cents per share. It is just mind-blowing stuff.
And the stock lifting, because I don't know how they were possibly going to, come in and obviously disappoint when their expectations were not just low, they were like in the ground and
yeah,
buried.
we talked about that.
So
yeah.
I actually thought Delta, and I actually bought it on the headline when it went down, when it dipped. It dipped on the initial headline to 22.85. I bought it in the 22.90s. I was like, okay, this is probably just going to rip right back up. And I've sold it already, so I can freely talk about it. It ripped up to it ripped up to $24. I sold a little bit soon. I was out at around 23.5, I think. But just for a quick bounce, because I was like, they're going to rally this no matter what, I think. Now, again, am I saying I'm putting Delta in my long-term portfolio? No. And look what UAL is doing. UAL is doing an offering. All these companies need money. So last night gets announced UAL doing a secondary offering, I believe 37 million shares. Not a huge dilution, but will be dilutive. That's why UAL is trading down here in the pre-market. Initial pricing, I don't know if they've come out with it yet, but they were talking about $26. So I don't know, maybe more of these airlines are going to have to do an offering. It's very difficult, and I don't have any confirmation on the UAL $26. That was that's still just talk. It was talk last night in the lower 26s. I don't think they've come out with the actual pricing on it yet.
Yes, they have $26.50.
Oh, $26.50. Oh, so they did. Okay, great. Because as of last night, I didn't check the UAL news. So as of last night, they were still just talking 26. Not too bad. 26.50. They didn't have to go down too far to get that done. With that being said, maybe these other airlines are going to have to do similar stuff. They're still burning cash like crazy. Like you're talking on this Delta report, and you can say, okay, yeah, they beat the expectations, which were in the gutter. But, really, when you look at this, they're losing, 51 cents, which are expected to lose 70 cents, but the revenue is going down. We know the guidance is going to be terrible. We know this last quarter had 2 good months in it. So wait till this next quarter, because this didn't start really till the last 3 weeks of March. So You really had
You're right.
A good 2/3 of the quarter was pretty much normal. I flew in late February. So, and I've been talking about this stuff for, forever, being concerned about it. I was kind of nervous on that plane. I'm not going to lie to you. But, if I was flying, everybody was flying. So now it's a completely different story. And we know Delta's burning a lot of cash. How they get out of this mess is if everybody reopens, everybody goes about their business. And that can happen. Obviously, we get a vaccine. We've talked about that. That's going to help. We get something that works, a cure, that's going to help too. But even if the economy reopens, so you might be coming in saying, well, I'm going to buy these airlines because Georgia's opening, Texas is opening, Tennessee is opening. Everybody's going back to their business. We're going back to normal life as it is. I don't think life is going back to completely normal, even if they start reopening the economy, because you have people like me that are like, I'm not going on a plane for a while. Not until I know I'm not going to get sick. Am I going to go out a little bit, go out to the park? Maybe. Yeah. But there's certain things, certain activities that there's going to be a percentage of the population that is still scared to do.
You're actually going to leave your property?
Maybe
Dennis,
not.
First you have to get out, you leave your driveway. Okay.
I never left my driveway before this started, Joel. I never left my property before this thing started. I was the most prepared for this out of everyone. I trade from home. I don't leave me and the neighbor here. used to have a competition who could stay in their home the longest. He beat the hell out of me. It was like 17 days or something. This was a few years ago. But I mean, it's
yeah, but he's 75 years old, Dennis.
actually he's not. So
you know what? I just want to make one final comment here on the airlines. And it's not going to be like a day or a week. Some institutions there's some big buyers here. I don't know who it is. It's not Warren because he dumped some at 20, but this just looks like an institutional accumulation formation, and they're just being patient and they're just buying stock because they know it's going back up. I don't know when, but that's the only thing I could see because there's bad news. The earnings aren't great. It's hitting it, but it still finds buyers. So, maybe 4 or 5 institutions want to own this between 20 and 24. And they're accumulating a position. That's or some large shorts are covering. Someone that's really confident in, what's going on. And then, we'll look back in 8 months and Delta's at like 37 and we'll say, oh, you remember when Joel said the institutions were buying at 22, 23? And I'm like, well, we didn't buy there. So
are you buying? Are you coming in and buying Delta here? Because I don't have the guts to do it.
I'm not doing it.
I look at it and think, well, why? When the market has rallied as much as it has, are these stocks still all in the gutter? You know why? Because they're still burning a lot of cash and there's probably more dilution heading their way. Warren, everybody's waiting for Warren because he sold some Delta and he sold some. Which other one did Warren sell? There was 2 airlines that night. Love? Was it Love he sold some?
Yeah, I'm pretty sure it's Southwest.
Love and Delta. He sold some. Not a huge chunk, but people were speculating, oh, he's just trying to get under 10% so he can do a huge deal. And the whole market won't know about it. That could still be happening, but I don't think that's the case. I think Warren's is lightening up because Warren's
that's another thing too. When you talk about what makes this different from the financial crisis, Warren hasn't stepped in, right? He stepped in at Goldman Sachs. He stepped into GE. Charlie
He's bought anything.
No, I know. He sold. And
that we know of.
That we know of yet, yes.
Yeah. Did you and you see Charlie Munger's comments? He's like, we're going to lose some companies. We are going to a recession. I mean, that he flat out
when he's saying stuff like that, it's not like that's coming from a discussion with Warren. He's not just coming up with all this stuff himself. Obviously, Charlie Munger's very smart, same thing. But I believe, there's still obviously Warren Buffett and they're having conversations here. And if Charlie's bearish, Warren's probably not bullish. So I think Warren was just lightening up too. I think that's the way, Warren is a fundamental analyst at heart, like fundies. And you look at the fundies on these airlines and you're like, ouch.
Do you know why Charlie's so smart?
Why?
He went to Michigan undergrad.
There you go.
And Harvard Law School.
Go Blue.
Harvard
wasn't
Harvard was my backup school for undergrad.
Right. Real quick, if I could bring it back to the airlines for just a second. Did you see what GoGo Wireless said yesterday? They said that this is the Wi-Fi providers on planes. They said their passenger traffic on commercial airlines in April was down 95% on a year-over-year basis.
I mean, this stock's right at the epicenter too. So it was where was it when it started? I'm bringing up the geo chart. So we were actually leaking way early in February. I guess people were really anticipating on GoGo. It's $1.55. It hasn't rallied at all. It had the little rally in March and gave it all right back. That was just a gift. I mean, this is a company, that potentially, is going to get hit really hard from this. And I think you know what I mean by that.
What was the trend before this in this issue?
Exactly. I mean, it's internet on planes. So this was a stock that had struggled for a long time. I mean, you look at the monthly back in 2014, this was $35 when everybody thought that internet's on planes was just the best idea ever. And now we realize, wow, internet on planes is cool.
I think there's competition.
Oh, for sure there is. For sure there's competition. I can get internet sometimes when you're on your plane from your own provider. It bounces around the towers, but when you're flying, you can get internet without actually going on the GoGo. Sometimes, can't you? I do sometimes.
Yeah.
You lose Dennis there?
No.
I'm still here.
What happened?
Joel, did we lose you? I think we lost Joel. All right. Well, we lost Joel, but in the meantime,
The go-go people cut him off.
Yeah, exactly
Talking
what
too
happened.
bearish.
Can't hate on
Conspiracy theory.
the internet providers here because they will find you. Let's do AT&T here. Speaking of internet providers,
Sure.
So AT&T had earnings this morning. Let me just turn Joel's frozen camera off there, so when he comes back, he will join us. All right. Anyway, moving on. AT&T reporting this morning, Q1 adjusted EPS 89 cents versus an 85-cent estimate. Sales 42.7 versus $44.2 billion. So an EPS beat. Sales miss for AT&T. Pretty diverse business. Obviously, they're seeing a lot of increase in traffic on their internet side of business, but the media side is struggling hard here. So it's kind of a hit and miss report for AT&T.
I'm so torn on AT&T. Part of me wants
Yeah.
to buy the stock. It's got a 6.86% dividend. I think the dividend is safe, but it's still a question mark. A lot of businesses, obviously, that aren't doing as well. But in this, it's not like COVID is really going to impact them in a negative way and put them out of business. And AT&T has been hit pretty hard on all this. So part of me thinks this is the kind of stock I want to buy. And then part of me thinks they got a hell of a lot of debt, and I still don't know if we're not going into a financial crisis part 2 here. I'm not saying it's a probability, but I still say it's a possibility. I've said that the whole time, which is why I've been very concerned about the banks. So if credit got tighter, AT&T could have struggles that way as well. I don't think that's going to happen. I don't think we're going into financial crisis part 2, but I don't know we're not. And that's why all of the stocks I continue to buy are stocks, tech stocks, with cash. Or like I said, I did buy the one utility in Canada the other day just because that would have debt problems too, but I got to own something. So I still like tech with cash. AT&T has a nice dividend and they have a sound business right now. I'm very torn. Part of me wants to buy AT&T. I'm very torn on it.
Did you guys notice that you lost me for a second, or did
we
Dennis
talked about it? Yeah, the go-go people were cutting you off.
I just didn't know that you were just talking. There's a chance you were talking the whole time.
Yeah, no, I know. I never stopped.
Should we devote 3 minutes to oil here, or should we save it after our guest? Do you want to get it out of the way?
Well, we were just doing AT&T quickly. Give us your technicals here, because I want to buy AT&T, but I don't.
What's the dividend?
6.85, Joel. It's almost 7%.
It's like I'm buying it. Let me see how much.
Are you buying AT&T?
I am. Point.
I want to buy AT&T.
Here's the trade.
Yeah, I'm scared.
But Dennis, the yield's going to be artificially higher because the price is lower. It's not as good as it sounds.
Yeah, but still,
what do you mean? I don't understand what that means.
Well, the dividend yield is going to go up when the price goes down.
Right, but
so was the price going to go down?
Yeah.
Well, I'm saying it's gone down. It's like the dividend yield is like
the 6.85% is not artificial. It is real. That money goes into your account every quarter. The 6.85% dividend is real.
I understand that.
He does. I know what you're saying, Spencer. But if it goes to 35, it's going to be 4%, which is still.
I'll sell it then. I'll make myself $5. Buy low, sell high.
This
is the name of the game.
Exactly.
Maybe your game, not mine.
Well, I don't want to buy high and sell low.
You got two. What about all those activists that were like when it was at 39? Where are all those guys hiding under their desk?
Oh yeah, it was crazy that it got up and they just were ripping it high, and people were saying, "Oh, it's got to go to $55." It's never going to $55. I don't know who the activists were.
Was it
Allen and AT&T? It was the next big thing. Let's talk AT&T first of all. They have some struggling businesses, so you're not just buying something that's awesome. That's one problem with buying it. The only reason I'd buy it is because I think the dividend might be safe and I like 6.85% yield. But the DirecTV part of this business sucks.
Oh, that was horrible.
Sucks. They paid too much for it. They've got, like you said, some of the media stuff in this is not doing that well. There's competition coming for the wireless part of it, of AT&T. There still is competition that's getting more competitive all the time. I firmly believe you will not be paying $100 a month or $80 a month or $60 a month for your cell phone 10 years from now. I think they'll be people paying $20 a month. Data is coming down. Prices are coming down. That will squeeze margins as well. Right now, it's not the case. They're still raking in the cash. People are still willing to pay a significant amount. I mean, my cell phone with all the stuff I have on is like $100 a month. I'm obviously Canadian, so say $75 a month. What's your cell phone cost? Joel, what do you pay a month?
Well, I got 4 people on mine.
Oh, you're on a big plan.
Yeah.
Well, I have 2 on mine.
Unlimited data. Why am I still paying for Dana's cell phone?
Eventually, you want to pay for, like, the unlimited is going to be in just parts of the plans. That's going that way too. How much do you pay for your cell phone, Spencer?
Mine's on auto pay, so I'll be honest, I don't really know. I'm sorry.
They love you. They love you.
Sorry.
You didn't realize they jacked it to $150 2 years ago.
I tend to check these things like once a year. I just switched my auto insurance for that same reason. I was like, whoa, I was kidding. You're paying more than I thought I was. But let's bring on our guest here. David Trainer is the founder of New Constructs and does some pretty good research with regards to earnings. Digging deep into the filings, into the reports, and looking at what kind of adjustments companies are making in their earnings reports, especially after the fact, right? Quarters down the line here. So, David, good morning.
Good morning. How are you guys?
Good. How you holding up here, David?
I'm doing great. Sorry, I'm going to get the video going here. I didn't mean to have it
on.
There we go.
We love video.
Holding up okay
in the radio star
in this market. David, I want to just get your thought. Do you have any thoughts on any of the earnings we've discussed today? We've talked about AT&T. We've talked about Netflix and Snapchat and Delta. Any thoughts on any of those reports that we just saw overnight?
Yeah, and I think you guys bring up a lot of good points. I think with AT&T, this is a large, almost sort of, borderline oligopolistic type of business. And I think we got to see through the dip on a lot of these stocks, and AT&T is one of those. I think picking it up with a close to 7% dividend is good. And when that dividend yield goes down, that's a good problem to have because it means you've seen significant capital appreciation. On Delta, I feel the same way. I think some people say, this is going to permanently change the way we behave. I disagree. For the most part, I think people are going to get back on planes, get back to living their lives. And I think that there's going to be a surge of people taking advantage of $90 round trip tickets from New York to Orlando, et cetera, to get back to enjoying life. I think that's in our future. And I think that, I love to talk about Warren Buffett and how much he stepped in during the financial crisis. And I think part of the reason he's not stepping in now is because I think the government got smart and they saw how much money Warren Buffett made because he stepped in when they didn't during the financial crisis, and they want to make that money. Look, they're in a position to be the lender of last resort in a lot of places, and a lot of the programs during the financial crisis were very profitable for taxpayers. And I think what we're looking at here is a dip, not a permanent decline. And if you can see through the dip, you're going to be just fine. And some of these firms have liquidity issues that mean they have to take on loans at onerous prices and onerous rates and low prices. And government's going to make a lot of money there. Now, Snap and Netflix, I have questions about the underlying merit of those business models and the competition they face, and I have for a long time. But they sort of like Tesla continue to defy reality. So I'm not sure how much fundamentals matter. And look, if they haven't mattered yet, I don't know if they ever do matter. But as a fundamental guy, I don't believe in those business models. I believe the valuations are way too high. But look, I've been wrong for a long time there. So I wouldn't take my word on those guys.
So David, your research hinges on what you call earnings distortion, right? And expectations are all over the board this quarter. Some really high, some really low. For most people, it's very low. But what are you looking for in these reports? Because these are going to be such outliers going this quarter and next quarter, and maybe the one after, who knows, going to be such outliers in the long-term scheme of things. So what are you looking for in reports that we're getting this season and next season?
Great question. We're looking for the fine print details that people are missing. So like, just for example, Twitter, we got a strong miss earnings distortion score on them. And that's because they had a benefit of a $1.2 billion deferred tax benefit that boosted their earnings in 2019. You wouldn't find that on the income statement. You only find it in the footnotes, and it's all around how they decided to move certain intangible intangible assets into another subsidiary. So it's a completely accounting driven, hey, we're going to move some assets from this part of the business to this part of the business, and poof, we got $1.2 billion of deferred tax benefit gain in our earnings. And it's things like that people don't know about. You can't find on the income statement, that we pull out of the footnotes, that we go in and say, oh, these numbers have been boosted over time by some artificial gains. So that consensus number that has been embedding this artificial gain is in jeopardy of falling, because they can't produce artificial gains in a perpetuity. In other words, the core earnings of the business aren't that strong. And so there's risk that they're going to miss.
So do you expect then that more companies are gonna, how do I phrase it? There's gonna be some more footnote shenanigans this quarter and next in these earnings reports, just because the financials are just totally out of whack?
Well, let me go back to one of your other points, and that's the quality of data. There's going to be real issues with quality of data, not just because analysts don't know what to expect, but because a lot of the companies that collect the data, they all do it in offshore places where COVID has completely locked things down. So they've got like call centers of people pulling data out of filings and updating models. And that's been disrupted as far as we can tell. And so financial models and databases aren't going to be getting updated. There's a lot of ambiguity and murkiness around all the numbers, and that's going to create volatility. Now, when it comes to whether companies are going to be trying to like bury losses and gains in the footnotes at this period of time, what we've seen over time, Spencer, is that when times are bad, we see a kitchen sink effect, right? When companies know that market sentiment is against them and they're going to get less bang for their buck, so to speak, on earnings beats, this is when they take all the charges they can. They clear the decks so that when the market goes back to bull market phase, they can be beating the numbers. And we've seen this historically. We did some work for the SEC on impairments several years ago during the financial crisis. And the spike in impairment charges during the financial crisis is huge. Same is true back during the tech bubble, right? So kitchen sink effect. A good friend of mine, Mike Mayo, covers banks, brought that up a long time ago. When it's bad, just throw all those expenses down.
Yep, we talked about that. Yep. We're on the line with David Trainer. He's the founder and CEO of New Constructs. David, I know you drill down into the earnings, and I look at the overall market, right? And for me, from my perspective, the market's telling me that exactly what you said, that we're going to be returning to normal soon, that these companies like Delta and all these ones are going to be up in our bargains and everything, and you just got to be patient. But on the other hand, when I do leave my house and I drive around and I see no businesses open, I see high unemployment in different areas, and really don't know where our GDP is going to go. I mean, we talk about this quarter, we talk about next quarter. Could it maybe be like Q4 of this year or Q1 of 21, really, before we see a substantial turnaround in earnings?
Hold on a second. Let me check my crystal ball. Look, the timing on these things is tough. But I think that what we do know is the policy response, the government policy response here has been unprecedented in swiftness and size. And they learned their lesson from the financial crisis. We need to get money into people's pockets fast and in large amounts. And I think that they've been really diligent in making sure that the amount of stimulus provided is commensurate with the amount of GDP lost. It's not going to fix everything. Money doesn't solve all the problems. There are going to be some serious issues here. But in terms of being able to survive it, yeah, we're going to survive it. And in many ways, honestly, I feel like the human race does better coming out of crises like this, especially America, especially the United States. We're resilient. We tend to be, more like when the tough happens, when it gets tough, the tough get going. And there's going to be damage. There's going to be pain. There's going to be lives lost. There's going to be lives lost because of the economic damage, in addition to the COVID damage. There's going to be livelihoods lost. There's going to be families broken up. There's going to be bad things certainly that happen. And I think a lot of that's priced in.
So, David, looking ahead here to companies who are going to report in the coming days and weeks, are there specific industries or sectors or types of companies that you think are maybe most vulnerable to a big miss or a big beat, even though, as you say, expectations are kind of all over the place?
Yeah, I think the consensus numbers are tough. I've been told by some of my clients that the Bloombergs and the other consensus earnings numbers are just not getting updated. And it's not necessarily an issue with the consensus collectors. It's that some analysts just, I think, haven't been updating their models because they don't know what to put in there. I think, look, on the downside, look, oil's going to get crushed here. I mean, negative prices that we've seen is sort of an unprecedented kind of thing. I think you just got to be careful there. I don't know. I'm not sure what to think there. I do think we're going to see a rebound there. I think we might even see a spike in above normal prices in oil just because we're going to have a big depletion in supply because of this issue, and then demand picks back up and supply and production will pick up as quickly. But in the meantime, that's a scary place to be. However, if you're looking at some of the refiners and the firms that are dealing with the end customer aren't as much related to exploration and production, you could see some surprises there because they're not as price dependent. In terms of beats, I think you want to go to the firms that are benefiting during the crisis, the firms that are into online delivery. And I think even some of these restaurants might do better than you think. I mean, for example, the Olive Garden and Texas Roadhouse, Darden restaurants. I mean, we've seen their online deliveries pick up huge. And it's not going to be enough to compensate for what they lose in the restaurants, but their revenues aren't going to zero. And I think a lot of investors are pricing some of these stocks as if revenues or rents are going to go to zero. And so that's where the opportunity is.
Yeah, one thing to point out in restaurants, the ones that are still staying open, they're probably reducing their overhead by quite a bit, right? As far as the staff. I mean, I'm sure they'd rather have fully staffed restaurants and everyone going in and out, but they are cutting costs. So Spencer's taking like my last three questions, and then your answers are been my other question. I guess the thing to wrap up here is what about the banks? I mean, the loss provisions for JP Morgan, they didn't bounce that much. How are you interpreting bank earnings so far and moving forward?
I think, I looked at the excess provision there for JP Morgan, and I thought it's an embarrassment of riches. They've got plenty of capital to set aside for a rainy day. And look, there's no way that these systemically important banks are going to have a problem going. If they have an issue, the Fed will be there to save them. These are basically almost like utilities with a lot more upside and growth, because they don't have regulated pricing because of how much support they have from the Fed. And so I think the banks they look really strong here, and I'd look to pick up these stocks near their, all around this time. Banks they're going to come out of this fine. There's not going to be any banks going down. They're doing huge business with the SBA. I mean, this is an opportunity on banks for sure.
And then just real quick, David, before we let you go, you sent over a list here of names. You are expecting Whirlpool, Eli Lilly, Illumina, and Old Republic all report tomorrow, and you expect them all to strongly miss the estimates. Can you explain just one or a couple of those and why?
Yeah, like I was saying with Twitter, and same as for all the companies, what we're looking at is we're pulling out data in the footnotes where we've seen unusual gains that have been baked into the earnings. So the accounting results, the consensus results are incorporating unusual gains in their numbers that we don't believe are sustainable. And so the likelihood of a miss for those four companies, there are 10 companies on the list I gave you. Twitter is one of them. Pfizer is one of them. Whirlpool is another one. And when I'm digging into the footnotes, I'm pulling up the model right now, right? And I go in and I say, okay, what are we looking at here with Whirlpool? And I'm seeing a bunch of stuff. There's a sale leaseback transaction for $106 million. There's a $95 million gain on a sale, a $16 million gain, a Brazil indirect tax credit of $180 million bucks, another non-recurring gain of $110 million that was related to another sale leaseback transaction. And then let's see, on a sale of properties, on the sale of properties, you've got 111 million, 95 and 16 million. So, with Whirlpool, you've got not just one big item. There's a bunch of little stuff. A lot of the work we do gets missed by other analysts and other data collection firms because in many cases, the individual charges or gains are immaterial. But when you add them all up, it becomes material. There's a legal entity merger tax impact that is actually an unusual income as well that they figured out a way. So, Whirlpool's an example of, this was back in 2019. It's baked into the numbers. When times were good, these guys were figuring out ways to get the numbers boosted to ride the bull market wave. And I think we'll see the opposite coming into this sort of downward economic time and downward earnings revision time.
All right, David Traynor is the founder and CEO of New Constructs, helping us out here by looking deep inside earnings reports and filings and giving us some good thoughts on who is likely to miss the estimates such that they are this season. David, thank you so much for the time and be safe out there.
You too. Great to be with you guys. Thanks for having me.
Right. Thanks, David. Great input. We're off to the races here. We're up 43 handles at 27.75. Coming up to the intraday high from yesterday at 77.50. Current high is 77 even. And what I mean by intraday high is that what takes place between 9:30 a.m. Eastern Standard Time and 4:15 p.m. Eastern Standard Time. There's a lot of people that just base their trading on that and ignore the overnight action. And I think that sometimes they may be better off. I don't know who was listening to the PMP show when we were talking about AT&T, but that stock just exploded. It's gone from 30 and a quarter up to nearly 31. So up $1.08. Or people that are getting those dividends are looking at it. That's for sure. Easy Mike says we haven't talked about Facebook in a while. When do they report, Spencer?
Good question. Let's look it up in the Pro. It should be coming up, I would guess, the next week, but let's confirm that with a look up in the Pro. I see Facebook on the calendar for the 29th after the bell.
Dennis, you want to comment on that one since you own it?
I sold it. So I sold it 2 days ago. And the reason I sold this was, first, I didn't like that it looked like it was failing around 180. I sold around, I think I sold it right in here, like 178, because it's up $7 today because of the Snap report. But I sold it 2 days ago, right before yesterday's fall. The reason that I sold it was I'm worried about advertising. I'm really worried that there's a lot of companies spending a lot less advertising now. I mean, I still like the Facebook medium and Twitter, and I still own a little bit of Twitter, but I'm concerned that advertising revenue is going to drop substantially. It just makes sense. The logic says that advertisers are going to get hit, that there's going to be less people interested in advertising when their businesses aren't open. So there's a lot of stuff still not open, and that's why I sold my Facebook. The 180 is huge on
the
technical perspective. So it was like the ducks were in a row. I was like, it looks like it's failing me at 180, and I don't like the idea of the advertising revenue dropping substantially here. It's still, I like Facebook. I think I'm going to get it cheaper. So it's more of I will rebuy this, but once we have some clarity on when we're coming out of this. But just to think that advertising revenue isn't going to drop for all these companies, or isn't going to drop, so maybe it's going to drop somewhat, but isn't going to drop substantially, I think is absurd. I think it's going to drop substantially, because there's going to be a lot of businesses that are going to advertise less when their businesses aren't open. And other businesses trying to survive.
Or they'll be negotiating cheaper deals, right? Better deals. But I mean, you nailed it, Dennis, because I just looked at the 50% retracement. That comes in 180.60. Your 2-day high, 180.50. Your 3-day high, 180.28. So if you're looking for follow through here, getting above 180, closing above 180, then maybe you get a look. But barely got up to its 50% and holding in there. So really like that 180.50 high of the move level. And if you're not a higher low of the day kind of person like me, 179.24 has been the high closing of the move. We backed $9 off that. I mean, we're right back up there now. So you want to, take a good look here at this 180 level if it comes into play in today's sessions.
Can we talk USO for just a second here? I learned something new, and Dennis, I'm not sure if you knew this, but yesterday they announced that they were halting creation units for the fund. I didn't know that an ETF could have a maximum number of maximum available share limit. I didn't know that was a thing. So they halted creation units yesterday. That led to USO closing at a 36% premium compared to the NAV. And then this morning they announced a 1-for-8 reverse split, which you had to figure was coming at some point. So a 1-for-8 reverse split, and they have filed with the SEC to create more shares or to increase their available share limit. But the fund has become so popular in the past couple of days that they literally hit their available share max. And so now the fund is at a massive premium to the NAV. So
you think about the people who bought 2 days ago at $4 or $3.80 or $3.90. I mean, Nick was smart. He just did it with the option, so he's not getting burned too bad. And it's a binary bet for him, win or lose. But people are just flat out saying, "Oh, oil's got to come back. I'm going to go buy the USO." Got absolutely murdered yesterday. I mean, to the tune of losing at one point in time over 40% of their investment in one day. I cannot see any reason to own this ETF. And the reason is because I think the super contango is going to be here for a while. Oil demand is low, and this keeps getting burned significantly because they got to roll those contracts. So even if they start rolling out 2 months, they're still getting burned. I mean, to watch the June collapse like it did yesterday is one thing for the May, and to go negative because nobody's taking physical delivery. But you could have taken physical delivery. And how low did we get yesterday on the June WTI?
$6.50.
$6.50. This is a direct hit. So this is how you directly get hit with that front month contract. You look at the XLE, you look at the XOP yesterday, they were hardly down. XOP was up. Such a better way to play and get oil exposure than going into the USO. And did you also notice OILX? So for you traders who trade that, UBS's oil tracking stock as well, announced that they're going to call it all in and they're going to redeem it all last night. So OILX is going to cease trading. I believe they said May 1st. I'd have to go find the press release again just to find the exact date. But yeah, so they're calling it in because they probably don't know how to handle the same situations here. So they announced it last night, 7:36. It's going to redeem the whole thing May the 1st. So UBS Investment Bank today announced this from the press release that it will redeem all the outstanding securities of OILX on May the 1st. So OILX is going off the board because they don't know probably how to handle the same issues. I don't follow the OILX, so I don't know exactly how it's structured. I'm guessing because of the chart yesterday that it's structured similarly to the USO, but even reverse splitting and doing all this stuff doesn't really help the problem. The problem is this oil front month contract being worth so much less than the next month and having to roll it all the time. So there are so many better ways. I mean, even today, you got oil stocks ripping higher here this morning. And you got USO, it's up 1.7%. So not even hardly participating at all again. ExxonMobil's up 3.8%. Chevron's up 3.56%. The XLE is up 3.68%. Halliburton's up 3.89%. Most of your oil stocks are up 3-4% today. USO can't even participate today. Hardly. It's up 2.49, but still up 7 cents after losing $1.20 yesterday. Doesn't feel good. So if you see this continue where people don't want to take the physical storage and there's no place to put it, this is a direct problem for the USO. Way better places to get oil exposure.
You know what?
We've said that for years.
When is the reverse split supposed to be?
They announced it today. Crap, I didn't write down the date. I'm sorry, I didn't write down I don't know when
Okay, because I'm
when
just
it's going into effect.
I'm going to buy like a zillion puts on it wherever it's at. That's not a recommendation. That's
it. Joel. Anyways, just looking at this situation here, I want no part of this. I want no part of the USO. And do you think reverse splits help you? Check out the chart of CHK. CHK reverse split there 4 or 5 days ago.
Oh, it's after I got the date. It's after the close on the 28th.
Reverse splits don't help; they hurt. So this is, not going to solve the problem. The problem again is super contango, and I don't know how the hell they get out of it. Until the market starts to stabilize, and maybe there's going to be a lot of tankers. Maybe there's going to be refiners. Tommy Lackey in the chart. Maybe the refiners start taking in and more and storing more, obviously, because they can benefit from these low oil prices. So maybe there's going to be some scrambling to do around. But the short-term problem is there's no storage, and there's actually producers looking like that they might have to pay to have them take the oil away, which is crazy thought process.
Hey, Dennis, though, I mean, I'll just tell you here, if you the contango that you're talking about here,
yeah,
if you look at like the September contract, it's still contango, but someone thinks that right now the crude's going to be $24 in September.
Sure. Why isn't
it? August. Yeah. And then the September, someone
But
thinks
here's the flawed thinking, Joel. People think that because I think oil is going to be $24 in September. But you want to know something? Buy USO today, thinking, oh, well, oil's $7. Where's the June? Where's the June right now?
The June crude is at 1336, up 16%.
Up 16%. USO is up 2%. Not tracking very well because there's still a serious contango issue for the USO. June crude up 16%. Their underlying holdings are in the June crude. Yet this vehicle is only up 2%. That's a problem.
Partially, they had to go out further. They own July and August.
Any regard here, their underlying holdings, and like you said, the underlying holdings are even way less because of the NAV. You just looked at it. But if people think that if oil goes back to $24 and it's currently at, what'd you say, 16? No, 12?
14. It wasn't 14 and now it's
$14. People think that it goes to 24. I'm going to buy USO and make 70% on my money. It's not the way. It's not the case. That's not how it works. The USO's got to roll all this. The storage costs are too high. There's in all likelihood that if oil is $24 in September, that USO could be lower than it is now. That's the tracking error that we keep talking about, that we've talked about in the USO for years. If you think oil is going up, buy oil stocks. I don't think oil is going up. That's why I don't own any oil stocks. I don't think it's going up long term. I don't know if it's going to 20. Maybe it could be 24, sure. But the current contract or whatever. But it's that really bailing out. Anyways, I've talked about oil so much.
All right, I just want to say one more thing, Dennis.
My point of the story is don't own the USO. Own something else.
I got to correct you. The USO does track very well on the downside.
It tracks overly well on the downside. It's a serious issue. OILX, and does anybody follow the OILX? I don't know how. We've got to go read the prospectus on that. But they're closing shop, and I probably think it's similar structured. I don't know because I don't trade the OILX. I just watch it go, but I get some serious volume. Does anybody know if that's structured the same way in the chat, where they do the rolls front month going in the next month? Anyways, they're saying we can't beat this, and we're just closing shop. So UBS is saying. I don't know if USO is going to have to do the same thing. I'm not sure. But as of right now, they got serious problems with this super contango. And until we get open with the economy, I don't think it gets fixed immediately.
All right, that'll be a good place to wrap up our show today. If you missed any part of it, catch the replay on YouTube or the podcast on iTunes, SoundCloud, Stitcher, TuneIn, or Google Play. Please remember all the information from our show is meant to be used as informational purposes and not for investing or trading advice. On tomorrow's show, we'll be joined by Joey Agri. He is the CEO of Agri Realty, a REIT here in Michigan. We'll talk about the commercial real estate market with Joey on tomorrow's show. Joel and I will be back with you at 3:40 today. In the meantime, thanks to everyone who joins us. Thanks to everyone who participates in our chats. We love it. Everyone, be safe wherever you are and have a good rest of your day.